Good morning and a warm welcome to all our investors, analysts, and our leaders here at RPSG Goenka Group Investor Day 2024. Can I have a round of applause as I say that? Thank you very, very much. Thank you, everybody, for being here. It means a lot to us. Thank you for taking your valuable time out for our very important event. I'm your host, Vyoma Parihar, for the day. I'll be here throughout. With a legacy of over 200 years, RPSG Goenka Group is the fastest growing business conglomerate spanning wide range of businesses such as energy, specialty chemicals, BPM, entertainment, FMCG, media, sports, education, and infrastructure. With an employee base of 55,000 plus, 60 plus countries. Ladies and gentlemen, without further ado, I request you all to kindly put your hands together in welcoming the chairman of RPSG Goenka Group, Dr. Sanjeev Goenka, and our vice chairman, Mr. Shashwat Goenka, on the dais. Can I have a louder round of applause, everybody? Welcome, sir. Nice to see you. Welcome. Please take your seats. And now I will be inviting all our senior leaders of RPSG Group companies to come on the dais. Now let's welcome on the dais Mr. Kaushik Roy, Managing Director, PCBL Limited. Welcome, sir. Now let's welcome Mr. Rajarshi Banerjee, Group CFO and Executive Director of Finance, CESC Limited. Welcome, sir. Now let's welcome Mr. Vikram Mehra, Managing Director, Saregama India Limited. And joining us virtually all the way from US, now I'd like to welcome Mr. Ritesh Idnani, Managing Director and CEO, First Source Solutions Limited. He's right there on screen. Now I'd like to welcome Mr. Vineet Sikka, Managing Director, Distribution, CESC Limited. Mr. Brajesh Singh, Managing Director, Generation, CESC Limited. Now, let's welcome Mr. Sandeep Kashyap, CEO, Renewables, CESC Limited. I want a little more energetic round of applause if possible. Thank you. Thank you so very much. You know, this keeps the energy going of the event, yeah? And last but not the least, Mr. Anuj Singh, Managing Director and CEO, Spencer's Retail Limited. Now, as we have all our leaders right on stage, it's my honor to invite on stage Dr. Sanjeev Goenka to speak few words. Everybody, Dr. Sanjeev Goenka on the dais. Welcome, sir.
So let me add my own welcome to each one of you. Your presence makes it special for us. We haven't done this. And so we begin, this is the first time we are doing something like this. And we do believe this is the time now to communicate the story of the redefined RPSG. The new aspirations, the new ambitions, the new growth story. Our DNA has changed from being incremental to being exponential. And that is reflected in the plans for each of our companies. The last few years went in actually earning the right to grow, getting our processes right, getting technologies right, spending, investing on innovation, on reinvention, on invention, on research, on development. And now all of it is coming together. And this is the time, coupled with the fact that the Indian economy is booming, to take advantage of the growth of the economy, to take advantage of the sectors where the government policies are conducive to growth, to grow. And grow not 2x in 4 years or 5 years, but to grow 4x, 5x. And that we do believe is possible. And we have laid down a blueprint for it. This blueprint embraces green. It also redefines us in terms of getting into higher margin businesses. We are focusing on higher returns on equity. So you will see, you will discover that ROEs for most of our companies will grow by 40, 50, 60, 70% over the next few years. In terms of capacities, you will see significant growths across all our verticals. There are new age businesses like chemicals for the EV batteries, for which the pilot plant will get commissioned soon. The technology is proven. And then we get into commercial production. That should happen soon enough. Green chelates, green energy. And each of these projects are profit intensive. They are ROE accretive. So you will see in CSC, the ROEs will grow by 30% from 12 to 16. In PCBL from 15 to 25. In FSL from 14 to 21. In Saregama from 14 to 20. And this can go, I can keep giving you numbers and statistics. But I'll start with PCBL specifically, which for me personally is extraordinarily exciting. In terms of rubber blacks, we will go up by 4 lakh tons which are identified, in addition to what we have. The specialty black will double. The margins will grow at a consolidated level from 20,000 rupees to 25,000 rupees. That is a result of a higher proportion of specialty blacks, a higher proportion of value-added blacks. So the combination is you will get 4 lakh tons of additional capacity and additional contributions across the whole board. So that's one aspect. Then the nano silica project, which is going to be 2,400 metric tons, which is again, in terms of contributions is very, very significant. Aquafarm, our chemicals vertical. We are growing in every vertical of the chemicals, in phosphonates, in oil and gas chemicals, in green chelates, and we will backward integrate into yellow phosphorus. So there is going to be a very exponential growth across all the verticals of PCBL. Not only in terms of volume, but in terms of margins. So we expect this company to be 4x, 5x of where we are today in the next few years, soon enough. Happy to say that the new plant that we set up in Tamil Nadu is rated as the most efficient plant in the whole world. And that is what we will replicate across all our new capacities. In less than 12 months, we got to 100% capacity utilization. And that speaks volumes, not only for the market, but more importantly, for the respect that PCBL has in the market. We've patented oxidized and power grades. We are going to get into hybrid carbon black, which is graphene plus carbon black. Our joint venture with Kinaltek actually gives us, it's a unique technology. It gives us enhanced battery capacities, which enables higher mileage to the EV. It's faster in terms of charging. It's safer in terms of the battery chemistry. It's better in terms of carbon footprint and cost per unit of energy stored. The commercial plant of 2,000 tons, it's a capex of about 28 million. We should commission within 26-27 financial year. In phosphonates, we are growing from 82,000 tons to 124,000 tons. In water soluble polymers from 12,000 tons to 35,000 tons. In green chelates from 3,000 tons to 25,000 tons. In oil and gas chemicals from 15,000 tons to 35,000 tons. These are identified. These are already under various stages of implementation, but it doesn't limit us to just this. This is the beginning. In a snapshot, we have 3,500 crores, 3,800 crores of debt that we took for the Aquafarm transaction. We have 3,500 crores of capex as we go forward over the next few years. We expect to see cash flows which are at least 50% higher than this cumulative commitment. So it puts us in a safe position for further expansion without leverage. If I talk of first source, the plan is completely in place to grow 2.5 times, 2.5x from where we are. It's simple value unlocks. It's just applying a banya buddhi to the business. There's no great rocket science in what I'm saying. It's a new company in terms of DNA. It's virtually a new organization. So some old stalwarts like my CFO Dinesh Jain is here. He continues from the past. But many of the people, or most of the people, are brand new with new energy, with new drive. So to illustrate Our pipeline has gone up from 480 million to 825 million. And that will grow up to about 1100 to 1200 very shortly. We used to get one large win, two large wins in a year. We've got 3 large wins in the last quarter. Last quarter, we had contract wins at an ACV of 80 million, which is at least twice what we've ever done in the past. Our pipeline in large deals has gone up from 141 to 448 million. In our top 50 accounts, we had less than 2% wallet share. And we said we have access there. We have credibility there. It won't take that much to increase our wallet share in each of these accounts. And we are now focusing on them. We are focusing strongly on each of these accounts. And in this first quarter, accounts where our wallet share increased was Newrez, Mr. Cooper, Molina, Sky. And deal wins in existing accounts went up to 62 million. Now the potential here is anywhere between, if we actually keep scaling this up just with existing clients, is between 400 to 500 million. We've never looked at change requests from clients in terms of additional pricing. Just to put it in perspective, Accenture gets 5% of its total revenue from change request repricing. Is there a potential here? Clearly there is. And this is something that we need to look at, and we will look at, and we will address. We have to take our margins from the 11% that it is to about 14%. We have to take our revenues growth to 15%. So what do we need to do? Margins, roughly 0.5% will come from operations, 1.5% from costs, 1% from pricing. It's a very simple, broad, macro level position of where we could be. We need to focus on shifting our delivery model in favor of offshore. Onshore margins are 12%, offshore margins are 20%. We need to take 50% of our revenues to offshore. As of now, we stand at 35%. And in our new deal wins, we are structuring it in a manner where significant share is offshore. Attritions, that's another area where we've not been that efficient. We do believe there is scope to reduce significantly in attritions, and that's a high cost lever. Then look at tuck-in acquisitions, which are higher in margin, which have adjacencies to where we are, and which help us serve our clients on a 360-degree platform. So for example, the latest acquisition that we've done, it's QBSS. It has strong capabilities around coding and denials management and clinical documentation. And these are all high margin businesses which have adjacencies to our existing businesses. This is an area where we did not have a presence. And this is 100% offshore. It's 25% margins. And this is the way we will inch our margins up on a weighted basis. We will continue to be sustainable, and we achieved a score of 62 in the Dow Jones Sustainability Index. We are focusing on enhancing our digital transformation capabilities, data, AI, analytics, trust and safety. And all these, we do believe, give us the confidence of going from where we are to at least 2.5 times. And that we are very confident of getting in the next 4 years. I come to power. And I'm going to get Shashwat to speak more about our big thrust on renewable. But we are moving from strongly government intervention intensive, regulatory intensive kind of structure to a structure where we take the destiny into our own hands, get into a lower cost zone, control the deliverables, be competitive such that the regulator has no scope to tamper with your margins. So renewables is a low-cost option. It's of course green, but it's a low-cost option. We've got 3.2 gigawatts of projects which are identified. Shashwat will speak more about it. We are looking at cost control. So we have identified about 300 crores of cost savings in CSC system. For our plant in Maharashtra, we have 300 megawatts, only 70 megawatts that we sell in open access. Our contract with public sector undertakings of about 230 megawatts comes to an end in March. That gives us the potential of taking 300 megawatts to the open market. And that could give at least about 100 to 140 crores of additional profit. The new coal policy, which was announced a few days ago, has the potential to increase about 140 crores to Dhariwal's bottom line. Consumption is growing. Greater Noida is growing at 26%. CSC grew at 8%. This is after 40 years of growing at 1% and 1.5%. So again, here we are taking the control of our destiny away from external agencies into our own hands. And we are trying to define and we are trying to chart a path where profitability goes up at least 2x on a consolidated basis over the next few years. Saregama. It's been a story of constant reinvention. It's an industry which changes dynamics very fast. And we've learned to respond faster than others. As a result of which today, we not only have the music rights of all the big banners, Dharma, Maddock, Sanjay Leela Bhansali, Vidhu Vinod Chopra, Balaji. Not only are the top hits ours, the biggest hits of this year are ours. What this enables us to do is get a higher share not only of viewers, but a higher command over the market. So in terms of the OTT platforms, you get a stronger negotiation ability. Eight of our songs crossed 100+ million views on YouTube. Filter Copy is India's biggest youth Instagram channel with 1.2 billion views last year. So we are now finding ways of accessing the youth through social media. $750 million smartphones in the country. So video becomes a very strong element of consumption. $22 million connected TVs. So investing in films not only secures music, but gives us access into the video world, into the social media world. In films, let me just point out that 70% of our costs are covered before theatrical release. That comes through digital and TV licensing deals. All three top audio streaming platforms, Spotify, Saavn, Wynk, will turn pay in the next 18 months, we expect. And this will be a significant accelerator in our revenue models once they start paying. Average realization on streaming platforms is 10 paisa per stream. As the audio streaming platforms move to paid subscription, the average realization we expect would grow to 25 to 50 paisa per stream. I mean, if I calculate the numbers on this, it's staggering. But even conservatively, it's very, very exponential as far as Saregama is concerned. Our market share today in this thing is 18%. If 5 crore subscribers paid or adopt paid subscription, the additional revenue is 3,000 crores. 5 crores into 100 rupees per month, into 12 months, into 50% share for music label. Our market share is going to grow from 18 to 30% because of our content policy. So here again, we do expect to see exponential growth. Carvaan, which has been a technological marvel, we will shift to purely the e-commerce model. So we will restrict costs and we will have no losses on account of Carvaan. And let me just remind you that we are a company that is in IP. So the idea is to create content and own the IP. So all parts of IP, all formats of IP, the 1-minute short format content via Pocket Aces, 3-minute music video via Saregama, 22 minutes content via Saregama, 45 minutes content via Pocket Aces, 120 minutes via Udly. All these companies have redefined their DNA, have redefined their growth trajectory, have earned the right to grow exponentially. I come here today with a strong, quiet, but certain confidence of growth, of high growth. Yes, we have got into other verticals like sports, where performance-wise last year we didn't do too well. But the first 2 years we did extremely well. But valuation-wise we've done, I would say, reasonably. 40, 50, 60, whatever it might be, appreciation in a space of 30, 32 months is not bad. Our FMCG business continues to grow well. Revenues are growing up. Losses are coming down. So it's at least another 3 years before we turn profitable. But it's something that we are excited about. Tuyam is growing well, growing rapidly. Bhoot, where we introduced the Bhoot chips, has become a brand in itself. We've got into instant noodles, and within 2 months, we've got to already, actually 6 weeks of launch. We are now doing 1 crore a month. We expect this to be a big area for us as we grow ahead. Nature's Basket does well, grows, has redefined itself again. Spencer's will be a managed for value business, and we do have plans in place to get it to break even before the end of this year. So that, in a nutshell, is about us over the next few years. I thought we must share this with you in person, so my entire team is here. And we are open now to any questions that you might have. Thank you.
So here we start with the Q&A. Yes, sir.
Can we request Shashwat to talk about the renewable foray as well?
Okay, yeah. Shashwat?
Good morning. So, I think over the last 2 years, we have looked at each of our businesses to see how we can redefine them and get them future ready. And our entry into the renewable space is keeping that in mind. Like Dad mentioned, we plan to install 3.2 gigawatts of wind and solar hybrid renewable energy over the next 3 years. The commissioning of the first gigawatt will start from March 26, and each year thereafter we will add 1 gigawatt. The green energy space for us is of course not only green, but it's also cheaper, which will help us become a lot more competitive. And this power will go into our discoms in Calcutta and in Noida. And this will allow us to additionally get some cost savings through in those discoms as well. For solar projects, we've got 4 projects tied up in Rajasthan, in Badla, Sirohi, Nagaur, and Bikaner. Land acquisition has commenced for 4,800 acres already. For wind, we have 8 projects totaling 2,300 megawatts that are under development across Gujarat, MP, Karnataka, and Andhra. We've already signed framework agreements for supply and EPC of wind power projects with Inox for 1,500 megawatts and with Suzlon for 1,000 megawatts. So I think overall, we have a large ambition as far as the renewable energy space is concerned, and 3 gigawatts is just the starting point, with an endeavor for us to take this upwards of 10 gigawatts in the near future.
Good morning, Sanjeevji. First of all, super presentations, and thank you very much for this grand initiative. I hope I'm audible.
Now, yes.
Yeah, thank you. I'm Rajesh Kothari from Alpha Accurate Advisors. Just one question which I have, that in this grand plan of exponential growth, it would be great if you can just share company-wise capital expenditure, what you are envisaging over next 3, 4, 5 years. Probably that will help us to understand a little bit more. And also, if possible, maybe how that is going to be funded. Is it because I understand you are a debt averse, so can be then internal accrual or equity. So that will be great. Thank you.
Okay. So for PCBL, the total capex is about, as it stands, is 3,500 crores. That's PCBL plus Aquafarm. And our cash flows over the next few years are going to be 10,000 crores. So, I mean, it's very comfortable from that perspective. As far as power is concerned, the capex on hand is about 17,000 crores. It will be 1:4 debt equity because it's renewable. The equity will come in from CSC and Greater Noida. And at some stage, we may look at listing. So these are the areas where the bulk of the capex comes from. Saregama sits on potloads of cash and good cash flows. So our acquisition from an operations perspective, from a current operations perspective, will be more than adequately met by our own internal accruals. But as we go forward, if there is some substantive acquisition, then the situation could be different. As far as First Source is concerned, again, we are very comfortable in terms of debt equity at this point in time. And cash flows are strong. So we are going to sort of, what I have outlined to you is on the basis of our existing cash flows and what we can take. I'm a very debt-averse person. So my guideline to my entire team is that at no point should the total group exposure, it should not be more than 1.5:1. And that is also for a short period. I can't sleep if I have too much debt.
True.
So maybe it is not the best policy, I don't know. But that's the way I operate. So it's largely internal accrual based. And some of it, so if some very exciting opportunity comes up, which every day you keep seeing different things, then of course capital markets are always an option.
Sure. And through this entire, within the group, are you looking for any inorganic opportunity? And if yes, in what verticals?
Sorry?
Am I audible? Yeah, my question is in terms of the inorganic opportunities within the entire group, which are the basically areas where you might look for, mergers or acquisitions?
See, one is where you actively look for, and the other is where you get opportunities. The focus is shifting to higher return on equity. So there is going to be a threshold. So if it's not, we are not looking at industries where you get 10, 12, 14% return on equity. It has to be significantly higher. That's point number one. Second is, if it adds to existing business, if it gives access to more customers, if it adds adjacencies, then those are the areas that we would look at. Going forward, there might be some pruning and reshuffling of portfolio, because one may move from a lower return on equity kind of business to potentially a higher return on equity kind of business. So it's very difficult to say precisely what, but right now our plans are confined to what I have already outlined. And growth is something that keeps, the pattern of growth keeps changing, and it's very elastic, so the elasticity keeps increasing. So I do hope this is the bottom line of our future and not the top line. In the sense that we hope to grow further and further. So as of now, if you say that, are we evaluating any further opportunities Yeah, there are a couple that we are doing in spaces that we operate in.
Great. Thank you, sir. Thank you.
Thank you very much. And I would like to request you all, please first introduce yourself and then ask your question. So any more questions? Any questions? Yeah.
Yeah, I'm Abneesh Roy from Nuvama only. Sir, very good presentation and extremely granular details you have shared on return ratio improvement in terms of the profitability focus, and you have given very strong numbers from a next few years perspective. My question will be in terms of the risk, because India growth story, everyone is very positive. We had our Hong Kong and Singapore conference last week itself. And we saw very strong belief in the investors' mind also in terms of the India story. But in terms of risk and pitfall and in terms of challenges, what will be the 3-4 key challenges you see as a group?
I think we have to make sure we execute well. And that is going to be important in terms of our growth and success of growth going forward. To my mind, that will be the biggest thing. The second thing will to be dispassionate about business, not to be emotional about business, and chop off where you need to, be firm where you need to. Do not let emotions get the better of you. So being a great place to work doesn't mean being stupid. So we have to divorce our emotions with people and introduce stronger accountability. And when you inherit legacy, you inherit lots of good things, but you inherit a few negatives. And for us, it's been one of being emotional about people. So I've learned now, at this late age in my life, that it's good to be emotional beyond work hours. During work hours, be completely dispassionate. So these are the two challenges that I think for myself and for all of us as a leadership team that we will be faced with as we go ahead.
Sure, thanks.
Good morning, Sanjeevji. Sagar Doshi here from Fintude Investments. So, thank you for the presentation. The growth story looks quite interesting. Now, I would like to touch upon our holding company, the RPSG Ventures. So, apart from having a good stake in First Source, it has many other smaller businesses out there. So, what's the outlook? What's the growth story for all those businesses? How are we looking at all those verticals? And what are the new businesses that we are looking to incubate in that holding entity? If you can just briefly touch upon that.
You know, I think one of the things that we are faced with today is many new opportunities. We can't do all. So we have to prioritize. So for example, in green energy, we are looking at hydrogen electrolyzers. That's something that we do believe offers a good potential. There are a few other businesses that we are evaluating, and we are taking the help of McKinsey to evaluate which ones are worthwhile and which ones not. And as I said, there might be a potential of sort of modifying our portfolio, trimming it, and then getting into higher growth, higher margin, higher return on equity areas. So far, apart from what we do, it is hydrogen electrolyzers. But yes, I must confess there are a few other areas that we are evaluating. Some of them could be driven by the family office actually, to begin with. So it's not quantified enough at this stage for me to talk about it because it's still a little in the air. Our hands are full right now with implementing what we have on hand. So we are expanding in rubber blacks, we are expanding in phosphonates, we are expanding in green chelates, we are expanding in solar, we are expanding in wind, we are expanding in music, we are expanding in BPO. So there's a lot of things happening. I think there will be acquisitions, but in allied areas. But the newer areas, I think, for the next 12 months, maybe none.
Got it. Thank you.
Good morning, sir. Sumit from ICICI, and it's always pleasure to hear you, either offline or on the YouTube. And it's thanks to me, thanks for this opportunity. Just to add on to the previous questions, I am just looking at how do you look, what is your game plan in the CSC venture in terms of what's the plan in terms of the CSC venture to monetize various investments which might, like the say the IPLs, the sports franchises, not only the IPL but even the footballs and others franchises that you have, or will it CSC will continue to be an incubator and it will go, because there is a lot of opportunity there in terms of value unlocking.
I'm really not at this stage looking at monetizing any of these immediately. But going forward, we will list FMCG for sure. We're not going to list sports. I mean, whereas I do believe it's a multi-bagger from here on, but it's funded, and the only circumstance when we will monetize any of these will be if when there is a fantastic opportunity that comes our way. And that needs a large investment. Under those circumstances, yes. But going forward, from the family office, we do have some interest in hotel properties, some of them which may be quite valuable. So that could be something that we might look at monetizing in some way in the next few years. We do believe our management agreement with Taj comes to an end on 27. Their belief is a few years more. Now that's a matter of dispute at this stage. But whichever way, we do believe that's a large opportunity of monetization. And so that is also going to be available as capital for the future growth. So sorry, it's not a very clear answer, but
Hi, good morning, Sanjeev. Sanjeev from BNK. Sanjeev, sorry I walked in late, so you may have covered this point, but I'll still ask. You talked about emotion versus dispassionate view, and if you can give some examples of what you have done to kind of move from emotional to dispassionate, and also what are you looking, if there are some areas that you are looking at from this lens?
So to begin with, let me say that every business of mine is up for sale at an unreasonable value. So that's the first thing. There are enough opportunities. If we get big capital, we'll invest it gainfully elsewhere. So we are not being passionate about what we do. I mean, we are passionate about how we do what we do. But we are not passionate in the sense that we will not emotionally cling on to something just for the heck of clinging on. Two is, we will strictly enforce accountability at the workplace in terms of performance. So it will all be BBSC driven. In the past, we said, he had a reason for continually not performing. He's a sweet guy. So, this is okay. No more. Sweet guy is outside office. In office, it's strictly being monitored by performance. So very strong HR policies. It's a new HR team. Very strongly communicative. So everyone knows what is expected of them. and monitored regularly. And we are going to monitor everyone on deliverables. So we have targets of market cap, for example. We have targets of profits. We have targets of contributions. We have targets of production. So everyone is monitored on each of these parameters, and strongly and dispassionately. If I may use the word ruthlessly.
Hi, sir. Thanks for the nice presentation. Sir, one thing which I don't understand is why don't you have good ESOP policies across your company? We have seen Mr. Vikram Mehra doing a fantastic job over the last 10 years, right? You've given him ESOPs, given him a free hand, he has delivered, right? Why can't we have something similar? I'm asking, the entire management is there, so if you can throw some light on that, please.
You know, we are moving more and more towards ESOPs. Like FirstSource has very strong ESOPs now. Saregama has ESOPs. I think you will see us moving more and more towards that ESOP plan for almost all our companies. I must confess it was a mindset in the past. That mindset has changed. So, you know, one of our older people, he said, Vikram ko aapne itna de diya, hame kuch nahi diya. So Vikram has earned it. So, I think it's a mindset, and that mindset has changed. So we will incentivize. So long and short is you'll have fixed plus variable. And you will have incentivization for better performance. Between Shashwat and me, we have only 48 hours in a day. So we do realize we can't do everything. And we are not necessarily the best in everything. So we need good people, and we need to incentivize them. And it is in our interest to get the best out of everyone. So very selfish, vested interests, we will do it.
Thank you.
Any more questions?
Can I, if there are no other questions, can I just request our CEOs to just 1 minute each. Of course, they have their own sessions following this.
Sir, there is one last.
Okay.
Yeah.
Hi, sir. Arijit from Kotak Mutual Fund. Sir, on the particularly on the CESC, what are your plans? You said the 3.2 gigawatt that will start from FY26, the commissioning that to 1 gigawatt each year. Versus competition, don't you see the timeline is much delayed? I mean, 1 gigawatt, which you announced, which we all know 1 year back, will come in FY28. And the second question is the 10 gigawatt in that perspective, when are you planning that will actually commence? What is your target?
So 3.2 gigawatts is something that is already, identified and under implementation. So in some places you have the land already, you have land plus connectivity. In some places you have the land, you don't have the connectivity. So it's all work in progress. We started late on this. And we earlier, it was again a change of mindset from the past, where we believe this is not only just green, but it is a cost reduction tool. So this 3.2 gigawatts is what will actually go into our distribution networks in the various cities that we operate. So it will reduce the cost for us and or add margins to us. Now the next phase will be, you look at green, you look at renewable as a vertical which is standalone, where you're selling to the grid. Now, sites are important. You need to look at battery storage. You need to look at connectivity. And because in the past we were late, we missed on a lot of these things. We're making up. We're doing faster than ahead others, but yes, we did lose out. So we announced it last year. We started looking at things, but by the time you get the land, you get the connectivity, you place the orders, the EPC gets executed, there is a gap of between the whole process from getting land and getting connectivity is about 12 to 15 months. So that's what it is. This is the real position. Now, could we have acted faster in the past? Certainly we could have. Are we acting fast now? Yes, we are. So no beating around the bush and saying we were late in this. But being late doesn't mean we are going to lose the race.
Sir, my question was not about the past. My question is that 1 year back we announced, and the last of the 3.2 gigawatt that is we are planning, it will come in FY28. Don't you think the lead time is pretty high here? Why such delay? And secondly, some more clarity on the 10 gigawatt that you are planning. Okay. What is the timeline? What would be the composition? Some more clarity on that part.
So, as I said, it's also about getting land. It's about getting the right sites. It's about getting the right connectivity. And now the power grid connectivity is on a queuing basis. So those who've applied earlier for the same sites will get it earlier. It's about grid connectivity, so that's a big bottleneck, one. Two is capacities between Inox, Suzlon and other solar manufacturers is tied up. Chinese imports are not welcome. So it's a question of when they are able to supply. So it's not a question of when we set it up, it's a question of when they are able to supply. So they already have an order book. So we were late in the past. So yes, it is late, and this is something that we would try and expedite to the extent we can, but we would rather give you a conservative projection rather than an optimistic projection. As far as 10 gigawatts is concerned, work is on. That's the aspiration. We need to get the locations, the land, and the connectivity identified. And that process will take maybe another 6 to 9 to 12 months. But that project implementation will also get staggered. It's not going to happen overnight. All the big parcels of land, where there is good radiation or good wind, big parcels have gone. So now you get smaller parcels. So it's an aggregation of plots of land that you have to do, and then you have to see where the land is available and where the connectivity is available. And you have to marry the two. So you can get the land without connectivity, it doesn't make sense. You have connectivity without the land, it makes no sense. So there are areas in Gujarat, in Rajasthan, in Tamil Nadu, which are looking good. We are examining it, but each one of these needs a detailed study. So we've now got a full-fledged renewable team in place. When we started out, we didn't have a single guy in place. It's now a team of 30-odd people, very skilled people, headed by Sandeep. And now things are moving much faster. So if you ask me to give you a timeline, I think after the 3.2 gigawatts, when I talk of 3.2, what we have identified is 3.8. So I'm always conservative in my forecasts for the future. The rest, I think, will be staggered, but will accelerate from year 5 onwards, 4 onwards. It'll be much more than 1 gigawatt a year, because we are now getting to know the ropes of the trade.
So, very well explained. Just to harp on two things here. First, on the, do you mean that after this 3.2 gigawatt commissions, then we'll start working
No.
remaining?
No. What we have identified is 3.2 gigawatts of commissioning, and we have timelines on that. The rest, we don't have the land and the connectivity yet. So, but that is moving on. So that could be, if you get something that's quicker, there could be an acquisition in that space. You know, so those are things that we do not have the exact path forward for that journey from 3.2 to 10. What we know is we want to get there. But the how to get there is still work in progress.
Thank you, sir. Well explained. The last bit is on the, since I'm not much aware of your other business other than CSC, green hydrogen you mentioned. Do you see it will be in CSC or any other business?
Sorry?
The green hydrogen which you were mentioning. Is it CSC or in other business?
No, it will be as part of CSC.
Okay. Thank you, sir. Many thanks.
Thank you, sir. Oh, we are running short of time.
No,
Can you
we'll
just
take the question.
Hi, this is Mohit Kumar from ICICI Securities. My question is, can you verbalize your ambition on the green hydrogen? Of course, you have won a tender, I think, from the site. You have won a tender of 10,500 ton, right? My question is, what is the strategy? And are you looking also at manufacturing of the green electrolyzer? Any color would be helpful. I understand these are early days, but still.
See, we do believe hydrogen is going to be something that will power a lot of things going forward. So you need two things for this. You need a technology and you need a market. So we are looking at land in Odisha and we are very close to signing up that land. And once we get the land, then we can move ahead with the implementation on one hand and tying up markets on the other. So Odisha is because we do believe Japan, for example, is a good market. So it's easy to transport from there, it's cheaper to transport from there.
And any plan to manufacture electrolyzer? Electrolyzer. Thank you.
Can I just request each of our CEOs
Yes,
to...
Hi, good morning everyone. About PCBL, Chairman has already talked about everything almost in detail. So very briefly, what I have seen PCBL possibly 5-6 years back and what it is today, I'm sure all of you know that it is quite different. It is a completely different company. And this journey we started about 7-8 years back. Step by step we have reached where we have reached today. If we say that was PCBL 1.0, now we have embarked on a journey of PCBL 2.0. And I'm sure down the line after a few years, you will see another PCBL after this 2.0 journey. Chairman talked about all those things in detail, so I'm not getting into that really. Focus will remain on growth in every area, value-added growth. That is the focus area, whether you talk about rubber blacks, you talk about aquaform, and within aquaform there are 4 big verticals. You have phosphonate, you have got green chellets, you have got polymer, and chemical for oil and gas. To our mind, there's huge headroom in all these 4 areas when you look at the global market and our share within that as aquaform. And therefore, we feel we can grow and grow very fast over a period of time, adding a lot of value to the top line as well as bottom line. And in addition to that, we are looking at going beyond the core of carbon, and therefore we got into aquaform, now also into Kinaltech, which is battery for EV. It is an anode-based technology, nanosilicon technology relating to anode. And we are going to start the pilot plant very soon, and thereafter followed by commercial plant. And opportunity is huge to my mind. So in short, and we are very confident all this execution plan, what we are talking about, we have very clear vision on this. We have very clear building blocks in that. It's not that we are saying anything in the air. It is a perfectly planned journey, what we have already scripted. It is there on the drawing board. The question is successfully execution. Successful execution is the main question. And we as a team, we are quite confident that we will be able to do that. So cheers for that, PCBL 2.0. Thank you so much.
Vikram?
Hi, morning everyone. When we look at the media entertainment industry, there are a few facts that excite us a lot. There's close to 2 billion people between India and our neighboring countries who speak and consume entertainment that's produced in Indian languages. Second, 750 to 800 million people in India itself have carrying a smartphone. Each of the smartphone, as we all know, is equivalent to a computer or a television set. These are factual things. There are two sociological changes that are happening in the country now. If I take a pause at this juncture for 3 minutes, majority of you are going to take out your phones. It's not that anybody would have WhatsApped you, but it's a human tendency now. We don't know what to do with our free time. So we are constantly on a phone, which means that much more content consumption is going on the devices. And the fourth change, 20 years ago, when TV consumption used to happen, like Karan Johar used to say, जो family TV साथ देखती है, वो साथ रहती है. Everything has changed. Now husband and wife very often are sitting in the same room at 9 o'clock in the evening, but actually on two different devices. Which means, whereas earlier one piece of content was enough to satisfy the need of the entire family, now 2 or 3 pieces of content are needed. All in all, huge content opportunity sitting in front of us. We have taken a conscious call that we will not get into the platform business of reaching out, connecting with the people, but with the content business. Because content business is not dependent on any change in technologies. Lag Ja Gale was a super hit during the day of LPs, cassettes, CDs, and still on streaming platform is one of the biggest songs that you find. One more conscious call we people have taken, that rather than reveling in the past glory, we can stop investing in newer content and drive very high margins in this business. We will consciously go and invest to future-proof so that Saregama, which is so relevant today, continues being relevant 2050 and 2060 also, where for the younger people, Arijit Singh will have the same love what we people share for Kishore Kumar. Net, you will see that the company that's grown by 20% over the last 7 years, 20% CAGR, should be growing anything between 25 to 26% as we go forward. And PBT will start running at a pace faster than the revenue. Thanks.
Sandeep?
Morning, everyone. While the chairman and the vice chairman has extensively covered on the renewable part of our journey and the growth story which we are planning to build, I would like to submit over here that we started the journey almost 6 months back when I joined. And within the last 6 months, we have been able to identify and get connectivity and partial land which is under acquisition for almost 3.2 gigawatt. And as we speak, we have a pipeline of a little over 3.8, which is expanding very fast. We are working on getting to the new connectivity opportunities along with land and projects. And there is an additional pipeline of approximately 4 gigawatt, which is being under evaluation as we speak. So 3.2 gigawatt, while it is almost frozen for the next 3 years, and this is not a small number, let me explain to you. One of the largest developers in the country today are developing between 1 to 1.5 gigawatt on a year-on-year basis. So while we will plan to develop 1 gigawatt a year, we will be in the league of those large developers in the country, right? And we will be considered very serious players. On the 10 gigawatt, I'm sure that, as the chairman said, in the next 6 to 9 months' time, we will be at that position that we'll be able to secure connectivities and land, and probably, we will start our journey on that parallelly while we are working on the 3.2 gigawatt. Thank you.
Ritesh?
Good morning, friends. My name is Vineet Sikka, and I look after CSE power distribution business. So as Chairman explained that, in the distribution sector, we are focusing on the various facets of the distribution. He covered the power purchase cost, so more into renewables. So actually speaking, we are preparing ourselves for being future ready. When the competition comes in, the distribution business should be future ready. So we are basically transforming the mindset from a basic Bijli company mindset to a B2C mindset, because ultimately we are also catering to our consumers. And I firmly believe once you have an engaged customer, engaged consumer, the distribution success, business success lies there. So in addition to the renewables, where the power purchase cost will be optimized, we of course have our own generation plants. There also we are working together, myself and Brijesh, to optimize the power generation cost. We are also working on optimizing the operational cost in terms of O&M cost, in terms of overheads, etc. On the capex efficiency also we are working. So these are the various facets because since we are a regulated business, tariffs are uncertain. So only way is to optimize our cost, convert most of our things into on the cash side so that the regulatory assets don't get produced. So in overall sense, we will be making our company a future-ready company as and when the competition creeps in. Thank you.
Brijesh.
Good morning to all. Myself, Brijesh Singh, looking after CSC generation. As there are a lot of changes happening in the thermal sectors, power sectors, and the thermal power plant need to be future ready to match with the RE growth. And its need, a lot of improvement need to be done on the thermal side so that plants should be meet the flexibilization. We in CSC, our units are ready to match the future RE challenge. We are working on the lot of improvement initiative to how to operate the plant in a better way, how to change our operation and maintenance strategy to meet the flexibilization. Second part is now this commercial correct operation because economic dispatch is now the time when based on the low hanging fruits, low cost generation, we should maintain the generation optimum with the thermal and RE. As the chairman has told, we are expanding our growth in RE and this RE is going to use our embedded power and definitely the thermal is ready to meet the requirements. Thank you.
Ritesh, are you on now? No, sorry, there seems to be some technological problem. My apologies. It was a very important part of our thing, but my apologies. I'll ask Rajashri Banerjee, our CFO, to do a quick sum up.
Good morning, everybody. Chairman and Vice Chairman have very clearly explained our ambitions, aspirations on the power along with other companies. I would only mention one particular aspect of this time, the growth that we are embracing. Earlier, power always have been growing, but it was significantly asset-based and automatically went for expectation for higher tariff, etc. This time, it is a two-way match kind of a thing, asset growth versus the cost reduction kind of a thing, so lesser dependence on the tariff. So this is something very unique. This time, the growth ambition we are embracing, and we are quite hopeful that overall basis we will be able to deliver the kind of growth that we are expecting to have. That's something very different this time. Thank you.
Thank you very much.
Just try speaking.
It's working, Ritesh is working. Oh, wonderful. Thank you. Ritesh, finally.
Sanjeev, is this better now? Am I audible? Yeah. Yes. I apologize for this. I don't know what's happened with the line, but let me give you a quick snapshot on FirstSource itself. There are two key shifts that are actually playing out right now in the technology environment itself. One is in the macro environment, we're seeing the shift moving away from a high interest rate environment to a zero interest rate environment itself. And on the other hand, there's also the technology shift with what's playing out on the Gen AI side. We believe both of these are actually secular themes that are creating significant opportunity for FirstSource to grow at a much faster pace and capitalize on the opportunities that the market is presenting today to it itself. FirstSource today is a company which is roughly about 29,200 people. We're operating in the US, UK, Australia, New Zealand, and we have delivery operations in India, Mexico, as well as in the Philippines, as well as a small operation in South Africa as well. What I think creates differentiation for us in the marketplace today is our ability to be very narrow in the domains in which we operate. So we are hyper-focused on a few industry verticals. Financial services, healthcare, telecom, media, and technology give us the bulk of our revenues. And in that, we attempt to be an inch wide and a mile deep. We continue to double down our focus on those industry verticals. And within those, we try to be technology first. So our ability to combine domain, technology, data, and AI is what is allowing us to grow at a faster pace compared to the rest of the industry itself. The point Sanjeev covered in terms of the growth that we see, Based on the framework that we have outlined in the last 1 year, which is the One First Source framework, and you'll hear me talk about it a little later in the day in our individual sessions as well. The different tenets that surround One First Source are our North Star for achieving the 15% growth on a CAGR basis, as well as getting to the 14% margins itself from an EBIT standpoint. We feel very comfortable with what we've achieved, and if you look at the performance that we've had over the last 4 quarters, in some sense, that's reflection of the execution of some of the themes that outline One First Source itself. In a nutshell, if I were to leave you behind with what we really stand for, it's the intersection of deep domain, technology first, data and AI that is allowing us to define the new North Star for First Source.
Thank you very much. Thank you so much. Look forward to being in touch with each one of you. Thank you.
Thank you so very much, Dr. Sanjeev Goenka and all our leaders. It means a lot. And thank you for sharing all the journey of your respective companies and the visions in a nutshell and answering all the questions wholeheartedly. Thank you. Can we have a round of applause for all our leaders once, please? Thank you very much. And everybody, in a few minutes, we'll be starting with our main track session. Let me tell you, our first main track's presentation is from CESC Limited. So meanwhile, you can grab a cup of coffee and come back at your seats.